Good evening, everyone. Seeing we have guys at the stream. Hope everyone is having a good day. My name is Samson, and I'll be taking you for today's session. So if you can hear me, just say hi on the chat. If you can hear me. I'll be taking you through the session with on how to trade gold. But Robert isn't available today, so you will see him on Wednesday. Thanks, Anthony. Okay, great. I think we can begin. So I think if you've been following the webinars for this year, you will have noticed there's been a common trend, or the bulk of the topics rather. We've been covering a lot of smart money concepts. I don't know if any of you has noticed that, and we are trying to get in line with what. Let me increase this. We're trying to get in line with what we're trying to listen to you guys and seeing what exactly are people interested in and what we should cover and discuss in detail. So from I think around December last year to now, we've covered a lot of content around that topic. And today's session will be how to apply what we have learned so far, and we'll be using it on gold because also it's a very popular asset or instrument to trade. So when you're going through the session, I'll be bringing a lot of topics that we've learned already that have been covered on the YouTube live stream. And I think it's good to always go back if there's something that you're missing or there's something that you feel you've not grasped properly, go back to those concepts and then come back to this video. So I want to talk about this before we start, and we cover this in a trading psychology session some time back, and it involves the path of learning as a trader and how you usually progress. At the very start, you start with your current reality, which is your set of beliefs and what you personally think the market looks like and your expectations and all these things that usually every trader I know of, every new trader, usually start with a set of expectations. And then what happens is you get to explore the market and you explore yourself also. This is where you know how your emotions can sometimes be not such a good thing, and sometimes it can be helpful. And you also get to learn different concepts, and everything is just scattered. You're trying different strategies and all that. And it's usually a discovery phase for most traders before you finally get to the third stage, which is developing a trading model. But you do realize this is never the last bit. Usually the assumption is you're gearing towards something that you can give you 100% success rate. So it's like a money machine of some sort. And it's usually when traders try to look for perfection, where you're trying to find the one perfect strategy and you're trying to fight towards this thing that is almost impossible to attain. And yeah, at some point you learn that in as much as you have a good strategy, you should also, or a good strategy embraces imperfection. So one losing trade or a series of losing trades does not mean your entire trading system isn't logical. As long as it's based on a sound reasoning, as long as it's based on sound reasoning, then for the better part, that's the best you can get, and you should probably just rely on that for some time. And this is where you start internalizing the experiences, because once you have a trading model, there's a way someone can teach you and there's a way you can understand it. Those are two different things. And even I think this is an experience we've had with all sessions, is there's a way someone can explain to you something, and then there's a way you can use it in your own unique way. And this applies also to what I've been referring to in the first few minutes, which is you're trying to grasp these concepts that we've done from around December, and then you're building your own model to apply these concepts. And this is where internalization comes in. So today's session will be doing gold. And frankly, all the topics that we will touch on gold, we've already covered them in one way or another. It's up to you to remember them. What you're doing is helping you to synthesize the concept we've done thus far. So without wasting too much time, let me just go straight to the gold chart. So I think this is it. Okay. So I'll just clean this a bit like that, so that we have a clean chart. All right. So today's session is about having a trading plan using the 4-hour and then basing your entries on the 15 minutes. It looks quite simple. Chances are it is, but then you need to have all these concepts that you've learned so far to come up with a solid or a logical plan. So I usually like starting on the daily. So I'll use the daily and the H4 time frame interchangeably because they sort of give you a broader context of the market that is not too large. For example, if I was to go to weekly, then if I'm planning on trading for a few hours, this is useful, yes, but in my context, it's not really going to be of much use. So you choose a time frame that isn't so big. So daily and H4, if you're planning to trade intraday, is good enough. Okay, so you're going to use the 4-hour and the daily charts to give you a broader bias of the market. Now, bias is something that we have mentioned. The question is, how do you arrive at bias? Yeah. And before we go to today's price action or today's trading, which is at the far right, let's have a look at what has been happening previously so that we have a good understanding of what you're looking for. The first thing, there are 3 methods, I believe, that you can use to identify bias. First is looking at the state of the market, yeah, the direction of the market, which is, are we in an uptrend, a downtrend, all that. Secondly, you can be slightly more advanced and say you're looking at chart patterns, which is, are there any sorts of patterns that you can put yourself into in terms of context on the lower time frame that can guide your bias? And then lastly, you have your what you have been doing, which is smart money concepts. I don't like using that word, but trying to look at demand, supply, or demand and supply behaviors based off the price action you're seeing on your chart. And this becomes a little tricky because the more you get into these concepts, all the way from just looking at the trend to demand and supply concepts, it's very easy to be biased on the chart. I can be looking at this chart and already at the back of my mind, I know I want to buy. So that means anything that I see is going to just confirm for me that I want to buy here. So it can be tricky because the more advanced you get, the more subjective things can get. And that can be a tricky hurdle to get over. So I think practice usually just makes it a bit or easier with time to get the hang of it. Okay, so let's start with here. We've had this upwards push, and this is on daily. I'll use this alongside the H4. We've had this upwards push in prices. As a trader, you'll be looking at the swing points, you'll be looking at the sizes of the candles and all that. I'm assuming there's a level here. I don't want us to go too far back in time, but I'm just assuming there's a level there. And what happens is at this point, I know my bias is upwards, and that's just from looking at the trend. But then what happens when we break market structure? So I'm going to use the wicks today, like that. I'm going to use the wicks. So what happens when you break market structure? What happens when prices come down and fail to form a new high here, and they finally break structure? And this is on the daily time frame. Remember, these were equal lows over here. So if these are low and this is a low, most people, when they're buying, would want to put their stop loss down here. Yeah. So as a trader, I do know that we have a level over there, because let me just remove this again. We have that structure over there. I've seen this point, I've seen this candle bouncing off this week, and I've seen this bullish candle. If I was to trade this in an uptrend, I would want to put my stop loss around here. Yeah. And if I'm buying, then my stop loss order is to sell back into the market. So I know these are sell side liquidity, or this is where people have orders to sell based off of the fact that some had bought here, some are waiting for a break in market structure to sell lower. Yeah. So we have that level over there, and finally we came and broke it with this candle here. Yeah. So once we broke this level and this structure generally, then at this point over here, I know that my bias is supposed to be lower. Why? Because I've seen a break in market structure. Now what does that mean? Before we get to the next swing point, which was here, the origin of the move, I do know that, number one, whatever I'm doing in this market, I'm looking for selling opportunities on the intraday chart. That's the H1, M15, anything lower. Yeah, that's number one. Number two, I do know that in as much as I'm looking for sales, if I see buy opportunities over here within this level, so let me mark this one here. If I see buy opportunities any point within here, I'll be using a smaller position to go long and a bigger position to go short, because my general direction is lower. Yeah, the confirmation is probably this candle with this wick over here, after we've broken this structure. Yeah. Now the question is, why is our target down here? Yeah, we've had people for more than a month, from from February all the way to mid-March, that were buying this upwards move here. Yeah, we've had a series of equal lows over here. So I do know that if I'm about to sell, this is where my target is. Yeah. So in that case, what constitutes of our bias? Our bias will be based off of two facts. The first one is that, let me just do that. I think I should delete this. The first one is that we broke market structure. Every time the price comes and bounces off this level, more and more people put their stop losses here. This becomes an increasingly attractive area because we have a lot of orders lying around this point. Yeah. Once we break that structure, all these orders are triggered, and that's why we had a really strong bearish candle right here. Again, because price kept off bouncing this level every time and respecting it, then anyone who was attempting to buy at any point will be placing their stop losses here. This price drew to this liquidity pool over here, and we had this strong bearish candle that triggered all these orders around here. Now, this signifies two things. Number one, we finally broken the structure. the overall market structure. So my bias should be bearish, or my bias should be I'm looking to sell. Number two, we have a series of equal lows down here. Yeah, this is another liquidity area. So if my entry was here or around here after the retracement, after a slight retracement, my target will probably be here. And I don't have to trade intraday, or I don't have to trade for, these are probably more than 15 days. I don't have, let me even count them. I don't have to hold a trade for 15 days. How many days are these? 12 bars. These are 12 days. I don't have to hold for 12 days to know that my target is here. Yeah. Between this time when it broke and before it reaches this point, all I'm looking for is opportunities to sell. So my bias in this case is sell. So if I'm going to lower time frame, I'm looking to sell. However, what you can see here is price doesn't necessarily reach this level over here. And what we have instead is some buying around this point. If I was to zoom this further, yeah, we have some buying over here. That means even more people now have placed pending orders here. Why? Because if I'm planning to buy over here, then my stop loss will be down here. Yeah, and I'm not the only person thinking that. There are probably other people who think this thing has fallen too much. It's time for it to go back up. So if you place a buy here, stop loss is down here, and then you just wait for this trade, hoping that the market goes higher. But do we break structure? Because the previous swing low, the previous lower high was this one. We don't necessarily go and break it. I'm sure there's another level over here. So at this entire point, we do have confirmation, because now this is another series of equal highs. We do have confirmation that price isn't intending to break structure. So our bias is still bearish. Remember, we've not even gone to the 15-minute or the 1 hour to look for entries. We're just talking about bias up to this point. This point, I know this target hasn't been breached and we're in a downtrend. So I'll still continue to have a bearish bias. So for the entire, is it 2 months? From here where we broke prices to here, these are around 55 bars. So these are 55 days. I'm only looking for sells. If I see buying opportunities, I reduce my risk levels. Right here, we had equal highs. And if someone was looking to sell here early, then their stop losses will be here. We had that break and a liquidity hunt, and then the prices melted downwards again. Yeah. Then finally, what happened is we arrived at that level. Again, look at how large the candles are based off of what we know that for the past 2 months, these are more than 2 months, 1, 2, 3, 4, 5, for the 6, 7. For the past 7 months, gold has been respecting this level. So there are probably a lot of people placing their orders at this area. Yeah. What happens afterwards? We break this level, hit the liquidity, and now at this point, the bias might not be as clear as day and night as it was in this section. However, we've not yet broken market structure, so this shouldn't worry us, and we might as well still be looking for bearish trades or selling trades where we're looking for sells. Now, if you apply other concepts like order blocks and all that, obviously you can tell that, let me see this, that this here was some sort of order block, and then the market retraced back into this area before going lower. But before we even get into order blocks, we just know that where is the liquidity? What is the structure of the market? Are there any other patterns I can use to confirm my bias afterwards? Yeah. Another good example is this point over here, which we've been monitoring closely in the sessions we have in the class, is if you look at this law here, again, if you have equal laws like this down here, where price keeps on bouncing off the same level, then we do know that number of people have this area as an area of interest. Number one, either to pending orders. In case I bought here, my stop loss order will be here. Or in case I'm looking for this market on a higher time frame to drop, I might have a sell stop down here. And that is what is guiding me with on the first case, which is if at all we have buyers to the downside, this should be one of the targets from where the current price is sitting. So if I was to zoom in now to this side of the charts, so bias is going to save you a lot of time when you're looking for setups on lower time frames. So just bear with me so that we completely exhaust this topic before moving on to the next topic. Okay, so look at this point over here. So let me delete these ones. Should I? Okay, let me just delete this. Okay, back to our clean chart. Look at this point over here while you are discussing bias. Now I'll use H4. Before you get there. So what did we have? We had a break in market structure over here, a push upwards, and then we had this interesting phenomena over here. So on the higher time frame, it's clearer. So I'll just do that first to mark it. Let's see where exactly it falls. I think I can put it here. So this is seen as a resistance level that we can use. So let's go to a lot H4 if you've marked it correctly. Okay. I don't think it's correctly marked, but we will work with what we have. This needs to be higher. That is high. Okay, now it's okay. Okay, what happens? We have a break in structure over here. Price pushes higher. So we have, I'll just summarize the moves for now. We have prices building up like that. And then what happens is we fail to go higher. So this is market structure. Again, at the start of the session, I said you have to go back to all these other concepts that we've done for you to synthesize what you're doing today, because you are plucking different concepts from different areas of the charts to come up with a solid way of reasoning. And in most cases, if you are trading, you're not necessarily imposing what you know on the chart. You're using what you know to discover what the chart is telling you. And there's a key difference when I say you're using what the chart, you know, to discover what the chart is telling you, because in most cases, that's the best shot you have at avoiding market biases or biases of you already think you know what you're going to do with the market, then you're just confirming it. That's usually a very erroneous way of thinking. So again, practice will probably sort that out. In the meantime, all these other concepts we've been doing are building up to this, and we're trying to mix together what we know already. So in this case, we've seen prices forming a series of higher highs and higher lows, but at this point, prices fail to break higher. So we have another attempt to go higher and it fails, come down, and another attempt to go higher and it fails, come back down. And then finally, before we go to the break, we had another attempt. So we had 1, 2, 3 attempts to go higher. Again, from the notes, we know that if I'm attempting to sell this market, what's up here? You know that that's liquidity. Yeah. If someone came into these charts, let me just remove those so that it's clearer now. If someone came and wanted to sell at this point over here, then, okay, let me zoom this so that it's clearer. For example, if I sold on this engulfing candle over here, then my stop loss will be here. So if it's a sell order, the stop loss order will obviously be a buy order, an order to buy back into the market. Yeah. Assuming that has happened, not assuming, it has happened 3 times in this case, where we've had, let me just put this one. We've had people attempting to sell there, and where we are at the moment, there. So that can give you a good indicator that there is a lot of liquidity building up at this point. However, we also know that, again, from our knowledge, this is a ascending triangle. Yeah, so if it's an ascending triangle, simply means that sellers are unable to push the market lower than the previous swing low. So in this case, this low, this swing, this sell swing and this sell swing, this one is stronger than this one. So on every consecutive swing low, the sellers are weaker. So that can help you build a narrative of what is happening on the chart, which is sellers are weakening, liquidity is building up on the top side. That gives you a bias in the markets. Yeah. Finally, we had that break. And now what happens is if people are buying, then now your liquidity is down here because you probably want to take a buy trade over there and your stop loss down here. So we've slowly built that narrative. Let's see. Like that. Yeah. Because from this point all the way till this day, we've not had prices coming back again to this level. Yeah. And since we had this big push upwards, then we do know that the only time I'll be looking to sell is when the market structure shifts again. And in this case, if I was to go back to the daily for a bit, I do know that liquidity is down here. Yeah. However, I am still in an uptrend. So I'll be looking at other zones to determine my bias, my bullish bias. Now, in the event we break market structure, as we did here, this is when you start looking at this lower level as a potential target. Only in the event that you've broken market structure, because market structure indicates now that the bias should be bearish and your first target should be here. So at this point, all these days over here, I'm looking to sell. I may not have all the days necessarily selling, but that doesn't matter. As long as more days the price is dropping than it's rising, then over time, most of your trades are going to be in line with that trend, the overall trend. It doesn't necessarily mean you'll be right on all the trades, but it means if your analysis is good enough, then a good number, most of the times or majority of the times, you should be able to capitalize on selling or selling the market as the trend progresses lower. So this is how you determine your bias with especially a gold chart. I know this week we have NFP, we have the Fed speaking, we have a few speeches. So it's going to be volatile, and gold is one of those assets that can make or break your account. Having said that, then it's good to we cover this on a day like today so that during the week, you know exactly how to go about trading the markets. A lot of traders are going to try and take advantage of the volatility we have this week. And because it's gold, then you know what gold tends to do. We need to be careful with the asset, and we need to have a solid plan while you approach your trading, especially with gold. Okay, so in this case, after looking for sells, we know that the bias is low. And again, as I'm going to repeat, you're only going to look for sales at this point up to when this liquidity here has been triggered or has been run through. Now, in this case, we might be a bit confused on now where the bias is, because we've already seen the market running into this liquidity down here, and you might not know the direction of the next direction of the market. One of the reasons is the case is also because during weeks of major news announcements, prices tend to be quiet up to before the announcement, or they tend to trend in the direction of the expected news outcome. So that's one way to trade the news, is if people are expecting a better reading that's going to be good for the dollar, then guys are going to act in such a way that that is the case up to when either proven wrong or proven right with the actual announcement. By the way, you can keep your questions coming in while we discuss the charts. Shili saying gold pulled back till around 835, then shooting up to 1888. Oh, that's a question. We'll have a look at that. So let me mark those levels for you while we are discussing this. Let's see. It is 1835. Also, you expect a pullback up to, yeah, I think in the classes today, we've been, okay, one of the students or one of the guys doing analysis there has been trying to, I think has arrived at the same conclusion. Not so sure, but we'll look at it while you do the analysis today. Yeah, so since gold has run through this liquidity over here, it might not be as clear, number one, because of exactly what I've said, this liquidity. Number two, this week is packed with news, so we might not be quite sure with the direction of the market as of yet. However, this does not prevent you from trading in lower time frames, and that's what we're going to look at from here. Because we know all our key areas, then we can smoothly transition to lower time frames to see any interesting points that people might want to trade at the moment. So let me just move this out of the way. Okay. So on the lower time frame, which is H4 now, we've had a break in structure. And at this point, I'm primarily looking for smaller levels or minor levels within the major trend. First level, being the obvious one, is over here. So I'm trying to make this here. That. Yeah, so we've had the price touching this point before, and we've had prices running into this because of, then again, the same story, liquidity that has built up over here from guys attempting to sell this market to go lower. Yeah, so in this case, we've had a push to eliminate or to fill all these orders that are here. Yeah, and that's why we've had this breakout and a retracement. Now, the nature of this retracement is also key into understanding if you're going to go lower, back to these lower levels, or the market is just stalling, waiting for the major announcements for the week. Okay, having said that, knowing our key levels, I think this is a supply zone. So I'll just mark this while we are, again, at the beginning of the session, you've said you have to put all your concepts together, and that's what I'm going to do. Supply, demand, I think we've done them. I think there's a higher one, but I'll just mark this one. There's one over here, and then we had that retracement before continuation, but I'll just mark that one over there. So for context, we've seen the market rushing through to break liquidity on the higher side. We've seen prices, should I say, attempting to stall, but it's a Monday, so it also explains the low volatility today. And I'm going to go to what we managed to trade for the day, which is going to get me to the 15-minute level in a minute. Yeah. So in the 15-minute is where you take your trades after you've had all your context conversation in general. At the moment, we're not so clear about the direction of the market, but this hasn't prevented us from trading for the day. And having said that, we had a confluence for today's session over here. Yeah. So remember Friday's high. And if you are conversant with sessions, we had an Asia session high earlier in the morning. This is Kenyan time. Yeah. Then we had our higher time frame supply zone over here. And what happened during the London Open? We had this run for liquidity over there. Yeah. So in this case, again, the bias we weren't so sure with the bias, number one. Number two, markets I'm going to repeat this until you get the hang of it. Number two, the markets on Mondays don't really trade. They're not really volatile. Then number three, days before the news, it's usually very tricky to try and trade the markets because either move based on the expectation of the news or they don't move at all, especially when it's a really huge decision coming up. So in the morning session, after you've done all the context conversation on the higher time frame, decided that this is an area of liquidity over here. And this was buy side. Buy side liquidity. What happened during the London session? We had a run for that area over there. Yeah. Now this can be explained based off your higher time frame concepts. And then what happened? We had guys attempting to get in at multiple areas, some over here and some down here. Now, in as much as this seems like it was a good trade, which frankly it does, because we have a lot of, again, the concepts on supply and demand, I think you can go through the previous videos to look at them. But we had a lot of areas of imbalances. We had a lot of supply zones that were unmitigated. I think on the H1, I can see these ones clearly. Yeah, and generally looked like the market was giving a lot of reasons to drop lower before either continuing higher, including this zone over here, 1835. I think this is where Harshil was looking at this area of supply down here. Yeah. So had that push upwards. And now it seems as though the market is retracing. Again, there might be lower volatility as we anticipate the speeches. So that's one thing to look at. I do trade price action and charts, but I also never ignore the news or announcements that come in. Okay, so that's it for today's session. We've covered quite a lot, but the main conversation was before you get to your 15-minute time frame or your lower time frame sections to try and look for sales, always have the conversation of context from higher time frames. That's number one. Number two, try and build a narrative for at least the past either 2-3 weeks or 1 month of what price has been doing. If you can explain, if you can have a story around this movement over here, then it makes your work easier in determining what the bias is. And in most cases, traders just skip that and go to trying to spot patterns on the lower time frame and trying to enter from there. But the narrative way is usually better because you can, it's based on sound logic, and it's something you can do repeatedly on the higher time frame before now going to the lower time frame to put in your setups into action. Having said that, are there any other questions on gold or on the charts in general that you might want us to address? From the comments, or we're all good? Okay, in the meantime, I'll just go back to my slides. Yeah, so we've talked about your current reality, exposure to the market. That's going to have a shift in what you believe in as you're learning. And then you've talked about developing a trading model after spending some time going through different strategies, going through different concepts and theories in the market. And they usually come with a lot of lessons. They usually come with a lot of lessons. especially with regards to number one, the thing about you not having a perfect system. Just because you've lost one or two trades doesn't necessarily mean that your system is not perfect or good. It doesn't necessarily mean that you can't rely on your system. As long as it's based on sound logic, then that's as good as it can get in developing your trading. After developing a trading model, you internalize experiences. This is how you know your trading is different, because how someone teaches you, even right now when I'm talking, how someone explains to you a concept vis-a-vis how you understand it and interpret it and utilize it, going to be completely different things, especially once you start seeing the results of your trading process. And that brings you to a higher level of consciousness, which is you looking back and not believing why you started trading earlier with very little knowledge. And at this point, that's where you start seeing things at a much broader or a better perspective than where you are. And then you have wisdom. I think we cover this in length on the psychology section. And then finally, it brings you to a new current reality, and this cycle repeats. Yeah. Okay. I think that's it for today. Signals, we have a signal center, the main signal center with FXPesa. You can go explore that. We do have analysis sessions. So that's one thing you can try and look into in any of our social media, or you can contact us in any of the pages, and then from there we can discuss when you get in touch. We do have physical classes in Nairobi, Eldoret, Isili, Thika, and I think I've covered all of them. Yeah, and happy trading. It's going to be a very volatile week, and I hope it's profitable for everyone. Melvin says he's new. Melvin, you can visit any of our offices or contact us on social media. It's a pleasure to have you on board, and you can meet the family of traders and, I get to learn the ropes. How do you filter major and minor swing lows, highs when analyzing market structure? Yeah, that's a good one. It's a very tricky one, because one trick I do, let me go back to the charts. One trick I try to use is, first off, always use a higher time frame. It's going to save you a lot of work. Secondly, if it is very complicated, just convert to a line chart. It's as easy as that. Why don't you bring physical classes in Kisumu? We are offering, or we're planning on opening there. It's yet to be confirmed. I'm not so sure, but it's yet to be confirmed. But we will, we're looking forward to getting, because I know there are there's a lot of activities and interest from that area. So I think with due time, there's something that's going to happen. Yeah, so I think you can stay in touch with us, Anthony, and we'll see how you'll be updated on that. Yeah, so on the filtering swings, minor swings and major swings, convert to a line chart. This makes it easier for you. For example, like no, this is just one swing. I don't have to look at the minor shifts or minor changes in prices, because in general, it's just one big swing. Looks like a flag, might be. But yeah, most of the times, if you're trying to identify swing points, just use a line chart. It's going to save you a lot of work. Then come back to a candlestick chart after you've marked all your levels. Okay, what's your view on trading the market gaps, especially when there is a break in structure? Yeah, I think market gaps are effective because prices tend to be drawn to such inefficiencies. Again, we will cover price inefficiencies. Have we? I don't think we have. We'll cover price inefficiencies, especially with gaps, but prices tend to be drawn. So the only catch is you need a really good reason to know when price is finally going to start approaching the gaps. So again, it just goes back to the same concept of the same way you'd look at liquidity and see where the key areas where price is going to be drawn to, is the same way you're going to view gaps. In that case, have a good reason why price is going to finally turn, because you can be assuming there is a gap over here. Let me clear my chart. Let me just put an object. Assuming this was a gap and prices are still falling, you need to have a good reason why this is the turning point, so that prices approach the gap. The reason is to be really good. Otherwise, gaps tend to take out a lot of traders because everyone is trading with the assumption that prices will eventually come back to the gap. But who is going to be patient enough to hold out until it eventually does is a question. All right. Believe those are the only questions. Again, thank you guys for attending. We have another session. We have the evening sessions on Monday and Wednesday. And yeah, just follow the social media sections to know when the next one is going to be. Thank you for attending. See you in the next session. And have a good evening for those who are in our time zone.